Hello everybody, welcome back to our channel. Today, as you can see on the screen, we are going to talk about um, put option, right? So what is a put option? Let us try to think of heads of people who may trade in put options. If you have a lot of money to park, put option for you is an option where you can bet on prices not going down enough for a particular underlying asset or a stock and make money. So that is from the person who has money to bet and make money out of it. And if you are a person who is going to buy this option, um, what this means for you is you are a person who is betting to make money from the stock of the price going down. Now, this is very layman language and very simple language of how it may work. Let us try to look at this with an example. Okay, so okay, now let us go back to the stick figures. On the left side of the screen, we have person A, and this person A is a rich person. Let us say person A has money and person A has $1,000. Okay. Um, person B. Person B has, let us say, $10. Okay. Now, person A is willing. Person A and B, both of them are following a particular stock. Let us say they're following a stock called as stock ABC of company ABC. Uh, and current date when this is happening is, let us say, 1st January 2018. The ongoing price of this stock is $10. Okay. So yeah, this is just to set a context. This is the current situation. Let me mark this in some different color so it's easier for us to watch and follow. So current day. So we have now established the current day situation as we see in the color. Now let us say person B believes that the price of the stock is going to go down. Let us say the product is not going to sell, or some trade tensions are going to be there, or person B thinks the price is so high it has to fall down, or a recession is going to come. For whatever reason, person B believes that the price of this stock is going to go down. And person B wishes that person B can make money out of the price of stock going down. So let me write the belief. Price of this will be $4, will go down and become $4 in 1 year. Okay. Okay, so so this is the money of person B. Let me put this here. for our easy view, and this is the money of person A. Let me put this here for our easy view. Okay, so all right. So the belief of person B is the price will go to $4 in 1 year from $10. Person A believes that now person A might either believe that the price will go higher of this commodity or the stock, or will stay same, or may go down but not as down as $4, right? So let's write the belief of person A over here. Price will stay above $4 in 1 year. Okay, now we know both the beliefs. Now this is an ideal scenario where a put option may happen. So how will the put option happen? There will be a contract on the exchange between person A and person B for the underlying asset of stock ABC for the expiry of 1st January 2019. Why 1st January 2019? Because it is 1 year from 1st January 2018, which is date today. And we are both of, in this example, we are talking going as low as $4 from $10, right? So for that reason, the strike rate is $4 in this case. And we are assuming they will be trading for lot size of 1, which is 100 quantity. So at $4, the 100 quantity is $400, right? Now these parts which you see over here, which I'm highlighting right now, which is underlying asset, expiry date, strike rate, and the lot size, conceptually they are same as our previous videos which we had seen in our call options. If you had not seen them, then I would suggest please go back, go to my channel and watch those videos to set some context. Um, if you just want a quick reference, basically expiry is by when this contract expires. Strike rate is the rate which we are agreeing, where person B is betting that the price will go lower than $4 and person A is betting that price will not go lower than $4, right? Now for this contract to happen, person A is going to ask some premium. So let us say that premium is $10. Okay, now let me walk you through what will happen and how will this contract function from perspective of person A and person B. A person B, as you had noted, had $1,000. From this $1,000, they're just lying idle in person A's account. Person B says, okay, I'm going to deploy $400 and I'm going to sell put. Okay, so person A is going to sell put and person B is going to buy put. So anything on the left side of these two lines is person A, anything on the right side of these two lines is person B. Person A is going to sell a put, and for selling this put to person B, person B is going to give $40, sorry, $10. So the contract happening here is person A is agreeing to buy 100 stocks of stock ABC from person B within a span of 1 year, which is 1/1/2018 to 1/1/2019, and This purchase will be done at $4, and in order to make this contract, person B is going to give $10 to person A. The bet person A is making here is that the price of the stock will not go under $4, and thus person A will end up keeping this particular $10 premium which person B is going to pay person A. Whereas person B is making a bet just by putting $10 or paying $10 as a premium. But person B is making this bet based on the person B's conviction that the price of the stock will go beyond $4. Okay. So this is the contract which is going to happen between person A and person B, and this contract is going to be a put contract where person A is selling a put and person B is buying a put. Okay. I hope we are clear so far. If not, I would suggest go back and try to rewind, watch a video to get on the same page. Now let us move ahead in time. Let us say 2 months have passed. So let me mark it here. 2 months have passed since 1/1/2018. Okay. Now the price of the stock is, let us say, it increased instead. It went to $10. From $10 it went to let us say $12 a stock. This means that it went in person A's favor and it did not go as person B was predicting it will. Very likely for this contract, which is still valid for 8 more months, the premium, instead of trending at $10, is now trending at, let us say, just $7. Okay. Now what you see in this yellow line are the market condition or the market situation. Okay. Now couple of things can happen at this point in time. Person B would basically say that I have lost my conviction that the price will go below $4 and I want to cut my losses. And what person B will do is person B will sell this contract now, which person B had originally bought this, right? So person B would sell this contract now, and this contract might be sold to person, let us say person C. Let me introduce a person C. Okay, so this half person is the person C. Okay, and person C has conviction that okay, 2 months have passed, but person C believes that I still have 8 more months and this contract can still go, this stock can still go under $4. So person C will now basically pay $7 to person B. So there will be a transaction which will happen here, right? And this contract, which was between person A and person B, will now be between person A and person C instead. So basically person B, who had bought the put for $10, now sells the put for $7 and thus making loss of $3, right? And gets out of the contract. And now person C is in contract with person A. The premium paid by person C is just $7, and then this contract continues. I hope this is clear. This is a little complicated, but I hope I have been able to explain clearly enough from the three heads of person A, B, and C, right? Okay. Now let us say another situation. Let's say all from the remaining months. Sorry, I said 8 months. It should be 10 months. So there are 10 months remaining now in the contract. 2 months have passed. The premium was $7. Now let's say um, 11 months have passed in the contract, and let's say 11 months and 15 days have passed. Now 15 days have left for expiry, and the price of the stock now is, let us say, price of the stock at 11 months price is uh, $2. Maybe C is premium is, let's say, XX dollars, and I'll tell you why I wrote XX in just a minute. So now 11 months have passed. What person B believed originally that the price will go beyond under $4 has actually happened, but unfortunately person B already booked a loss, and it happened very late in the cycle, almost towards the end of the contract cycle. At this point in time, person B is in profit. The person B has only paid $7, right? And person B and person A has a contract. Oh, sorry, but I misspoke. Person C and person C has only paid $7, and person C and person A have a contract where um, person C can now invoke the contract and ask person A to buy this stock of 100 quantity in one lot from person C at $4, which was promised. However, as market rate is just $2, person C can buy it from open market at $2. That means that uh, the profit person C makes is the difference between $4 and $2, which is $2, into 100 quantity, which is 200 quantity. So person C at this point in time will make a $200 profit, minus of course $7 of premium, and minus any brokerage charges. So person C will end up making a huge profit in this scenario, which is just by investing $7 plus brokerage, and person A will be making fair amount of loss. Person A had $400 put in, whereas person A is forced to buy this as $400 when market rate is actually 200. So person A is um, going to make $200 plus brokerage as loss. Note that the reason I put this premium as XX is because usually this premium at this point in time will not be like $7 or $10, but the ongoing premium will be close to $200. And that is because whoever purchases this contract, in case C decided to sell it to person D, in that case, that person has already factored in profit of around $200. So for that reason, this excess dollars in this case will ideally become close to somewhere around 200 in practical scenario. Also, one more point to note in this scenario is, in order to do this contract, person A's $400 will be locked in with whoever is the brokerage firm person A is dealing with. And the reason that is done is basically to ensure that person A has capacity to book this loss up to $400 if the contract goes wrong in person A's favor, which is what happened in this case, right? So because the price was uh, uh, $2 at this point in time, and person A ended up making around $200 of loss. So this is pretty much how a put contract works. Um, and I hope I have been able to explain well enough for you guys to understand with context of person A, B, and C, who are the parties who are trading in this scenario. Thank you so much for watching. Like, subscribe, and comment, and I'll see you guys again soon. Have a good day.